problems that they have given for the purpose of getting MCQ or the solution, majority of the cases they focus on basis. Then second basis could be for capital gains, and third is this way. This is the order in which the importance that they have provided. So let us understand that property means real property and personal property. Real property would mean land and building, and personal would mean movable items. So movable items would mean computer, car, mobile. So such of those items will be taken up as personal. This is to be understood. Okay. So cost is equal to basis. What are all the items that will go under basis? So what items that will go into basis? So the money that you have paid to the supplier, then what else you should be having under that particular head? See, whenever you have an item, definitely people will be asking the question, what and all will go into that particular item? All incidental expenses. Incidental expenses. And one more important thing that we should always be understanding is that at certain points of time, if a revenue item is not deducted, it will automatically get capitalized. So for example, you have a building constructed and the pathway is not that great. So pathway you have spent some $1,000. I'm talking about in business run by the individual. If that item of $1,000 used for the purpose of constructing the pavement there or a sort of a platform that they want to construct, they have done. They have claimed this as revenue expenditure. So imagine that the income tax officer there, which you call it out as IRS, Internal Revenue Service Officer, is disallowing, saying that it is no longer a revenue item. So when it is no longer a revenue item, so please understand those items will be taken up for capitalization. This is a generic rule. You should understand what is not allowed as a deduction will automatically be capitalized. Not able to claim deduction will automatically be taken up for capitalization. So including any taxation. So these are the items that they will be incurring, and this is going to be the basis. Is that clear? All of you?
Yes, sir.
Yeah.
Right.
Yeah.
Sure. In India, what will happen is that we have section 47. What is this section 47 is communicating? See, certain transactions are transactions in the eyes of law. But these items are not transaction in income tax act. So for example, this is purely on to Indian side I'm talking about, so don't bring it to US. Why I am just doing is that from here I got to bring out a comparison that we will be making. So for example, you have an HUF, Hindu undivided family. So they go for partition of the assets and liabilities. When partition is taking place, so you find this may be consisting some 20 people consisting one HUF, and the property is transferred to their members. Members are getting. So each one getting 4 properties, let us assume. So 20 members there, 80 properties that they have, and each one of the members, 20 members you have, each one of them are getting 4 properties. So this transfer is a transfer in the eyes of law, but income tax department is saying it is not a transfer at all. See, once an item is not transferred, there is no question of capital gain arising out of that. Is it?